you very much, Aaron. Roger, do you have anything to add to, what exactly private equity is and how it fits into the healthcare M&A field?
Sure. Good afternoon, everybody. When I think of from a lawyer's perspective, and I think of private equity, and people ask me, what are private equity investments in healthcare? I always start with it's something more than venture capital investment. Generally, the companies are a little more mature than companies that bring in venture capital investment, and it's something less than going to the public markets for your equity. When I think of private equity, especially in healthcare, it's oftentimes situations where you have companies that are in need of capital, and they've grown to a certain extent where they can't really fund their own operations, and they need outside capital. And what they also need oftentimes is management to take them to the next level.
Hey, Roger, I didn't mean to interrupt you. It's Josh, but I'm hearing an echo, so it may be someone's on a speaker box.
Yeah, I'm hearing the same echo.
How is that? Is that better?
Great. That is.
I think that's better. Much better.
Perfect. Okay. So we'll go ahead and move on to the next question. What are some of the typical revenue or management sizes and location targets for private equity groups? Aaron, this question is all for you.
Sure. Well, I think what you find within the private equity markets, a wide spectrum of investment groups that are interested at all different sizes and ranges. Elm Creek Partners, for instance, tends to focus on what many would call the lower middle market, companies 10 to 50 million in revenue, 2 to 8 million of EBITDA. You can find firms that will focus even at the smaller than that, or at stay very much at the lower end of that scale. And then there is an increasing number of groups, in fact, maybe even the majority of them, that are sort of at the top end of our range and above. Companies call it 5 to 20 million of EBITDA and up, until you start reaching up into the highest echelons of capital deployment in terms of multi-billion-dollar companies. Sort of like so many other things in life, it's a period. The higher up in the pyramid, higher up you go, the more narrow the set of players. Really, no matter what size, shape, and form of company you have, there is probably an investment group out there that might be interested. With regards to locations, target sizes, again, many groups, particularly the farther down you go, do tend to segment themselves by region. We try, Elm Creek sits in Dallas, Texas. We try to keep most of our activities in kind of the central Southwest. I will tell you, with healthcare, we cast a little bit wider net, because more than anything else that we do, it tends to be more thematically driven. So we'll kind of reach out all the way to, say, Southern California, and all the way over to the South Atlantic. What's driving that for most folks is that, particularly the smaller the company gets, is there's an assumption that the more hands-on you're going to have to be in terms of being available for your management teams, and the ability to access them, get there, without it taking too much time, tends to be a priority, if you will. So, if we kind of rule of thumb, if we can kind of conveniently get there and back in a day, then it's sort of, we consider it sort of within our reach. So that for a guy in Dallas, that kind of takes the Northeast, some of the Mid-Atlantic, and the Northwest kind of out of our purview. Each group has their own little guidelines about how they do it. And then with regards to with regards to targets, I mean, that's every group has their own little flavors. You over time, guys like Blaine and others get to know groups like ours and figure out what's of interest to us based on what we currently have in our portfolio and just what other things we see going on in the market. Of late, dentistry has been extremely popular. Urgent care was extremely popular for a while. These are all sort of market-driven themes that a lot of private equity groups will rush into. And to the extent that you're either in one of them or an intermediary that is sort of has relationships with private equity groups that like your segment, they're very good at matching them up.
All right, thank you. Thank you very much, Aaron. Excellent answer. Now we're going to move on to the next question. Joshua, what are some typical deal terms that private equity seeks?
Thank you. So in terms of private, I would change the question a little bit. It's not just what private equity seeks, but it's in terms of just negotiating a transaction. What are some of the deal terms to anticipate? Probably the first is obviously purchase price and how a company is going to be valued. Generally speaking, companies are valued based on a multiple of EBITDA, or earnings before interest, taxes, depreciation, and amortization. And that type of formula is often used for a variety of healthcare industries. Interestingly, though, within physician services, and we've seen quite a trend of late in terms of acquisitions of a variety of different physician specialties, from anesthesiology to radiology to eye care and a variety of others. The more common basis for value is earnings before partner compensation times a multiple. And so to understand that calculation, you're essentially creating quasi-EBITDA in the form of what are the earnings of that organization, of that physician service practice prior to paying out the physician owners their full dividends or their salaries, frankly, because in many instances, what's left over in a physician group after paying all of its employees and expenses is what's distributed out in the form of earnings. In private equity, also look at the form of consideration. In many instances, the deal is not just an all-cash deal, particularly for a platform acquisition or an acquisition into a new niche or a new service line for that fund, or into a new region or state for that fund. And in those instances, the selling owners will often be asked to roll a portion of their proceeds in the form of equity that would be that would continue in the joint venture between the private equity fund and the owners on a going forward basis. That rolled over equity can actually be worth equal to what cash would have been worth at the time of the closing, and frankly, in many instances, it becomes worth more. If you believe as a selling owner in the vision of that PE fund, and there's a mutual sort of vision there to grow that platform into something much larger, we have seen many instances where the rolled over equity is sold 3, 4, 5 years down the road for a significant purchase price in a major liquidity event. Certainly non-competes and restrictive covenants are a key issue and a key term that private equity would seek. In addition to that, understanding succession planning, particularly again in the physician services space, but even outside of that with respect to management and leadership. If you are a selling owner that's thinking retirement within a pretty short horizon, then understanding and planning for succession planning and who's going to replace that doctor or that manager is an important point to consider. In terms of the transaction documents, you have obviously the purchase agreement and, if you're rolling equity, the operating agreement or shareholders agreement. And so other terms to be looked at are governance. And in many instances, particularly where the private equity fund is buying majority ownership, control over the entity is going to be an important factor to be considered as well. Frankly, even before you get to a point of a purchase agreement or a negotiated deal, in many instances, the fund will look for delivering or proposing a letter of intent or a term sheet, and in that document is often a exclusivity provision, meaning that for a finite period of time, anywhere for as short as 30 days, and in many instances more likely 60, 90, or 120 days, a to be negotiated provision. But during that time period, a selling owner or the company would seek to negotiate only with that PE fund and not solicit other transactions with other potential buyers.
Thank you, Joshua. Roger, do you have anything to add to that?
Yeah, that was a good very comprehensive list. I think one of the things that you have to think about when you're engaged in a transaction with a private equity firm in connection with the negotiation of the LOI and the purchase agreement, there are certain assumptions that that your equity sponsor is going to make about the condition of the business. And during the course, they'll do diligence around, and diligence often in these transactions is really important. And you'll see a fairly heavy lift on diligence, and especially around in healthcare, especially around regulatory issues and reimbursement issues. They're going to be very, very interested in how it is that the company that they're investing in has been reimbursed traditionally. Are they doing it correctly, especially if there's a fairly heavy Medicare or Medicaid component to the business? So they'll look at the quality of the earnings, and as part of that, they'll look at the reimbursement and are they doing it correctly? And they'll look at, again, around healthcare regulatory issues, Stark Law compliance, Medicare and Medicaid anti-kickback statute compliance, compliance with state laws, because all of that impacts the quality of the earnings, the amount of money they're going to pay, as well as the value of the equity on a go-forward basis. So you can expect that there could be adjustments before you get to the signing of the purchase agreement, or there could be adjustments after, and even post-closing through indemnities by looking at the representations and warranties and excluded liabilities, et cetera. You may have adjustments to purchase price. What goes along with that? Oftentimes you'll see a chunk of the purchase price put in escrow and held in escrow to cover indemnities or cover excluded liabilities or things that have arisen. And the thesis with that being that had we known when we proposed the purchase price or closed the deal, had we known that there were X, Y, and Z problems, we would have paid less. So therefore, we've been damaged and we need some money back. So I'd say to go along with all the things that Josh said, it's the diligence, it's the looking at the reimbursement and the regulatory issues, and then the indemnities that go along with them.
Thank you very much, Roger. Okay, Aaron, the next question is for you. When would a potential owner look to private equity as a potential partner in their current deal?
Sure. I think two or three things global or generally drive that decision, and they can have a lot of sub reasons why. But first is that they're seeking some sort of change of ownership, and that could be because whatever you're reaching retirement age. The business has grown to a size and a state where it's no longer in your comfort zone. Maybe you know that the next leg for the business, the next chapter of its life, is going to entail certain types of tasks and risks that you haven't taken before, and you'd like a partner in that. And that might drive you to either sell a majority or maybe raise some growth capital. Maybe sell minority control. That can take lots of different shapes and forms. But whatever the case may be, you've reached some sort of a point where there's more, there's a brighter potential in the future for the business, and it's time to change, time to make a change. We have seen owners, of course, also use it to solve problems. Sometimes we've met a few owners who knew they needed to change the team but didn't have the heart to do it, long-time employees. And so they've effected a change of ownership and allowed the new guy to do it. We've seen situations where the company just gets itself in a little bit of a jam, and sometimes you have to effect a transaction in order to get the platform back on the right track. So whenever it is that I think there is a whole host of reasons that can be a catalyst for seeking out capital, and then the trick is to find the right partners to do it.
All right, thank you, Aaron. Josh, what are your thoughts on this topic? Joshua?
I'm sorry, had it on mute for a moment there. Well, in particular, for those who are involved in physician services, what I have found repeatedly is that when physicians invest in themselves and capitalize on themselves, they typically win, whether it be in urgent care, surgery centers, or their medical practices, their individual medical practices. You know, so many times I'm approached by doctors who ask me for guidance on an investment in a restaurant. You know, I was approached the other day actually by a doctor who's going to be thinking of investing in a salad bar concept. And I just think, you know, relative to the ability to invest in themselves, that is a reason to consider partnering with private equity, because we are at a point in time where healthcare is evolving so quickly, and physician services are being valued by PE funds in a way that they are in high demand, that for those doctors who are able to find the right partner, I think the future looks very bright. And for those who don't and ultimately end up not undergoing a transaction, you know, there may be some meaningful regrets. I'm also a firm believer that proximity is power. And what I have found, at least in the PE world, is that many PE funds are filled with partners who are highly sophisticated, incredibly astute when it comes to financial prowess, and the ability to have access to those types of minds in terms of operating your business and figuring out a strategy for growth, whether it be organic or through acquisitions, or even frankly payer reimbursement strategies. You know, in my view, while doctors may feel and other business owners may feel that they can do it all on their own, the ability to access that type of mindset and someone who does this for a living in terms of investing in platforms, in my view, is a great reason to at least have the discussions with PE funds in terms of looking for the right partner. As I mentioned before, and I think this echoes Aaron's comments, the healthcare industry is clearly changing. From my perspective, to the extent any target or any company that's out there that has payer contracts, I would be very surprised if anyone believes that reimbursement rates are going to go up. And so thinking through the strategies and understanding that reimbursement pressures are likely to result in reimbursement rates, if anything, going down, then from my perspective, you know, understanding if all else stays the same, you know, this may be a good time to consider bringing on a partner to help mitigate some of that risk of downward reimbursement pressures, and also figure out a strategy to address those types of reimbursement pressures. In addition to that, we have found that with the right PE fund and access to other portfolio companies that they may have invested in, it may very well complement your business, whether it be leverage with suppliers, payers, or other resources that could complement the business that you're in. And then finally, I think timing. Timing is, you know, obviously key. In my view, the market right now is a seller's market. That won't last forever. It could very well become more of a buyer's market. Multiples are clearly favoring sellers at the moment. Interest rates remain low. In fact, they even dropped a little bit the other day, but could start to increase, which in my experience has had an inverse impact on the multiples that PE funds are willing to pay. In the industries that we see in healthcare, whether it be urgent care or a variety of physician services, remains highly fragmented, which suggests that to the extent you're at least rolling equity, there's an opportunity to become part of a platform and participate in the growth as consolidation comes about. So from my perspective, those are all a variety of reasons to consider partnering with a PE fund.
Thank you, Joshua. Excellent answer. So deals usually bring on some changes in general. I think we can all definitely agree on that. But Roger, what are the changes that private equity groups typically seek in post-closing?
Well, from my perspective, and Aaron, I'm sure has a deeper appreciation for this. But what I see, at least in the healthcare industry, and I do a lot of work around physician services as well, like Josh does, and physician-driven organizations, I think it's a few things. The really good firms, they tend to invest in really good companies, and if they do, they tend to be of the mindset that if it ain't broke, don't fix it. But what I do see them doing is, one thing obviously is they want to grow, and the way they're going to grow is they're not going to just grow organically. They're going to grow through acquisition or through bolt-on transactions. And so you will see them oftentimes very aggressively looking to grow by acquiring other like-kind businesses or like-kind practices. One of the reasons that you see companies come to private equity for as investment partners is because they also don't tend to have and don't have the ability to attract the management expertise that they'd like. Private equity, oftentimes through their operating partners, they have a lot of experience and a lot of ability to attract very smart managers, especially at business development, chief operating officer, chief financial officer levels. And so you will oftentimes see maybe legacy or traditional CEOs or traditional administrators leave and be replaced by kind of higher caliber or higher octane, at least, individuals doing that. The other thing that I think private equity is very good at, and this really goes to the reimbursement thesis, is they're really good at looking at revenue opportunities. And so a great example might be in dermatology. They will look to add on service lines that maybe the group didn't have the ability to add on, like a medical spa, or certain types of cosmetic procedures that the group just didn't have the capital to add on. So you'll see those types of changes as well around, being more efficient, maybe having better billing software, maybe having better reimbursement systems. Their revenue cycle management you'll see changes around rev cycle management too. So those are the types of things I see. You don't see, at least in the deals that I work on, you don't see a private equity sponsor coming in and cleaning house, because they oftentimes are already investing in a company that they're very comfortable with. And frankly, you don't clean house with doctors, because those are the men and women that make you all the money. So you don't see those kinds of changes.
Right. Thank you, Roger. Now, Aaron, with Elm Creek Partners, you're directly involved with private equity. What are your thoughts on this topic?
Yeah, I would echo everything that Roger just said. Maybe to just frame it a slightly different way. First, I think most private equity groups are going to be, first of all, he's right. If you're buying it, particularly if you're paying a relatively high multiple, you've probably invested yourself in the idea that the team that's there is pretty good. So, the notion that there'd be sort of drastic changes at that level is probably unfounded. Where we see the most change often is sometimes in the chief financial officer, that sort of role, particularly in the lower middle market. Oftentimes that's a role that might not even be filled, but now you have a company that, maybe was unlevered, that has no debt before, and now it does have debt, maybe even multiple lenders into it, and just having a team that has managed those kind of relationships before and knows how to communicate in those kind of environments can be all the difference at times, particularly when things go wrong. And not that anything ever goes wrong on an Elm Creek deal, but other people's deals, I've heard about it. So you oftentimes see either a change or a supplementation there. But more than anything, I think what private equity brings in addition to just capital is the willingness to change, right? I mean, there's yes, sometimes they'll come in with their own ideas, but more than anything, it should be an open-mindedness about what's possible and a willingness to take risk to try to make it happen.
Thank you very much, Aaron, for that wonderful answer. We're going to get back to the remaining questions shortly, but I wanted to take a brief moment to thank Ambulatory Alliances, LLC, for sponsoring this webinar. Ambulatory Alliances offers services in investment banking, M&A brokerage, joint venture structuring and negotiations, due diligence, valuations, and more. For a complete list of their services, visit their website, www.ambulatory.com. www.ambulatoryalliances.com. Before returning to the main event, please don't forget to message me any questions that you may have so that our guests may answer them at the end of the webinar. So back to the remaining questions on our panel. Aaron, what are the goals and investment horizons for private equity groups?
Yeah, so I mean, it's a sort of a hotly contested topic because nobody wants to exactly say what their return goals are, if you will. But you know, it's sometimes it's math is math, and you look at the multiples being paid and the average hold times, and you can all kind of figure out kind of where a lot of groups are coming in. So, but I think for the seller to think about it, particularly if you're going to be rolling over a piece of the equity, or maybe you have a seller's note in the deal or something like that. Most private equity groups are highly incentivized to make a return on capital that's measured in multiples of capital. That also translates into an annualized rate of return. But more than anything, multiples of capital are kind of what rule the day. And they are trying to certainly get north of double their money, if not get 3 or 4 times, if not more. That's in private equity. Venture capital, it tends to be a higher return hurdle. They have more losses, and they expect to have more outsized winners. Private equity is sort of more mid-range in the sense that don't hope not to ever really lose money, but we know that our upsides are going to be a little bit more moderated because of the types of risks and structures that we use. From a time standpoint, the average deal hold time today, is kind of in that 5-year range. It's been coming down a little bit over the last few years. It got very high during the last recession. First, there were investments made in sort of the 2008 to 2010 period. The hold periods for those investments, were longer than average when you compare the industry over the last 10, 15, 20 years. And the investments made over the last 3, 4, 5 years, the hold periods are getting shorter. And that's just a function of the economy. Maybe more than anything, though, think of it as this: when a private equity firm makes an investment, they're investing in what they hope to be sort of a chapter of that company's life, and they have an idea of where they're starting and kind of what they envision when it ends. And if they're successful, there should be a buyer for it. So, and that's kind of the path they're setting out on. So, it's kind of benchmarked to evolve over a 3 to 5 year period.
Thank you, Aaron. Now, Roger, I know that you also had something to say on this subject.
Aaron gave a very nice answer there. I would echo the fact that we have seen hold times come down, and I would agree it's probably a function of the economy. We've seen the hold times come down on the physician recap side. At least my experience has been on the physician recap side the most, and some surprisingly low hold times. It's interesting, though, because I think that also now has created certain expectations in some of the rollover equity holders' minds, how quickly that they're going to be able to take that second bite at the apple that they find so attractive. And I think maybe now, given the fact that we've also seen some of the discounted cash flows, the purchase prices that are being paid as a multiple of trailing 12 months earnings are going up quite a bit. That may, I don't know what Aaron thinks, but that might extend out some of these hold times to get back to more of your traditional hold times.
Okay, thank you very much, Roger. And now this next question is one that most sellers usually have on their mind when working with private equity. Do private equity groups want to own a minority stake or a majority stake? What are the different circumstances? Aaron, how is this typically approached?
I think the most traditional private equity groups want to own a majority stake. The minority and the folks who want to own minority interest or are willing to own minority interest tend to come in 2 flavors. They tend to be more growth-oriented investors, which there aren't as many of those out there. I'm outside of the venture capital world, which really doesn't. I mean, that's if we're talking about physician practices and retail medical establishments like urgent care. It's not really a venture capital type world. You're talking about growth private equity. So there are fewer of those groups. The exception being there are some what people would call mezzanine lenders out there. They take a subordinated position to any other bank debt. They tend to be a lot more expensive than traditional bank financing, and they will wind up taking minority ownership positions in a company, but that is an ownership position that is coupled with a very high cost of capital, a current pay type loan that you have to be able to service as well. It's a tool, it is a product that a lot of private equity groups will utilize in the context of a larger transaction. But there are some groups out there in that world that will do a deal without equity coming in. For what it's worth, in my experience, those groups tend to need platforms that are at least 2 million of EBITDA and up. And it starts getting easier around 3, 4, 5 million of EBITDA, where you can do a minority recap with those guys.
All right, thank you, Aaron. Joshua, what do you have to add to that?
Yeah, I would echo Aaron's sentiments. I think the exception is minority interest, and certainly in most instances, a majority stake is expected. I think it's probably helpful to appreciate that when a private equity fund is interested in doing an acquisition, that it is essentially a leverage buyout. So, and that in part could drive the desire to acquire a majority or controlling interest because there's a third-party lender out there that is helping with facilitating the owner's expectations in achieving the purchase price. And so as owners, a question to at least consider, whether it be a minority interest or a majority interest, is the amount of capital being infused by the PE fund relative to the amount that's going to be leveraged. And so understanding how those dynamics will work and appreciate that the more leverage that's put on the company, that's debt that needs to be serviced on a post-closing basis. So while there are some minority stakeholders, I think the conventional wisdom is that majority stakes will be sought, and with limited exception, as an owner, I would probably encourage that if you're interested in a liquidity event or a capital transaction, that the more conventional approach of finding a partner for a majority interest is going to end up in a result where you're more pleased with the outcome than a minority interest, because I found that even in minority deals, the belief by an owner that they'll maintain complete control is often misleading, and that even in a minority interest deal, the level of involvement that the PE fund or mezzanine lender will be looking for still is fairly significant. And I don't know that it necessarily ends up accomplishing what the selling owner may have initially thought in terms of approaching a fund for a minority position.
Okay, thank you very much, Joshua. And now the next question is actually going to start out with you. Many physician owner-operators are fearful that private equity groups want to run everything and can possibly just throw them out at any time. Is this fear warranted, Josh?
No, it's certainly a question that a physician owner should ask itself or himself or herself as part of a transaction. And, going back to the 90s where there were a number of public companies doing acquisitions, that concern was probably more warranted then than it is now. At least in the transactions that I've been involved in, it's an issue that is clearly addressed, but it's addressed in a manner that accommodates the physicians. I would make a distinction between the decisions that are important to physicians, particularly on the clinical side, and the willingness by a PE fund to accommodate those sort of requests, from decisions that are being made with respect to the non-clinical side and the business functions, particularly around opportunities for growth. The clinical decisions often fall in the helm of the physicians. Those business decisions will typically fall more in favor of the PE fund, But even in those instances, what I've found is that the PE funds that are looking to invest in healthcare services there's a general willingness to address those specific fears in a way that allows for governance so that the doctors feel comfortable that they're certainly not going to be kicked out. Frankly, in my experience, if a physician or an owner is going to be asked to leave, it's often because, particularly in the larger groups, because his other partners or her partners felt that person wasn't carrying their weight more so than a PE fund. So while it's an important concern to have, and it's important to have it clearly addressed in the transaction documents, it is a concern that we have seen adequately addressed in a way that's favorable to the doctors and gives them the assurances that they will continue to be involved in the business and involved in decisions that are important to them.
Thank you very, very much. Roger, please provide us with your thoughts.
Yeah, again, I'm with Josh. I don't tend to see it in terms of getting thrown out. One, for I think some reasons that I sort of elaborated on earlier. These are at least around urgent care, ambulatory surgery, physician-owned hospitals, physician practices. Only physicians can do the things that need to be done to make money, physicians and their extenders. And the private equity firms are making very large investments. They really don't want to upset that apple cart. And in fact, they oftentimes want to augment the number of physicians and providers that are in there. So from that standpoint, throwing people out and taking sort of this, arbitrary, capricious action, no, you don't see it. Is it addressed in the documents, the ability to terminate people? Yes, it is addressed in the documents, but I rarely see it happen post-closing. With regard to running everything, it's actually a bit ironic. Physicians, again, we keep talking about physicians because I think Josh and I do a lot of work around the physician-owned business area. Physicians fall into two categories, usually. One, the category of, I want to practice medicine. I don't like running the group. I don't want to be involved in management. I never have. Two, I've always been involved in management. I like being involved in management, but frankly, at this point, I'm tired of managing or it's reaching a point where I don't really have, the Peter principle has taken over, and I really don't have the ability to run this thing the right way. Those physicians tend to believe going into a transaction that they really still want to be heavily, heavily involved in the decision-making. In my experience, again, this is my experience, in many of the situations, what you find happens post-closing is there's almost a sigh of relief that there's a new group of people in that are going to run and make the hard calls, make the hard decisions, do the day-to-day things that, frankly, the physicians are now relieved they don't have to do. So this idea of we don't want them running everything turns into, thank goodness that they're here to run things.
Thank you very much, Roger. Now, while we're on the subject of management, Aaron, when does private equity bring in their own leadership to augment or replace the current management of a business they today help take over or work with?
Yeah, I mean, I think it's hard to generalize, but with regards to our firm, we usually have a very open conversation about what our intentions are. Almost every investment platform that we've had has had some form of augmentation or replacement. Augmentation is usually pretty standard and discussed ahead of time, oftentimes before we make the investment, almost always actually, and usually makes a lot of sense. It's oftentimes an investment that we want to make because of the ambitions we have for the business that the incumbent management team didn't want to make because they'd rather maximize earnings, which is a perfectly reasonable stance. Where changes tend to happen is when things go wrong and people don't respond. That's where it gets tough and sticky. That is part of our role, is to affect change if something needs to happen. So those are usually the two primary causes.
Thank you, Aaron. Roger, this next question is going to start with you. What are some of the investment theses, such as growth equity, recapitalization, etc., How are they implemented, and what are the typical parameters of an investment thesis?
Well, I'll have to call on my MBA, which I don't have, but what I do see in transactions is usually the deals that I work on tend to be recapitalization transactions. And what those really are, as Josh referred to earlier, they're really, to a certain extent, they're leveraged buyouts. The PE fund comes in and they replace generally a large chunk, anywhere from 60% maybe to 90% of the equity of the owners, with a combination of their own equity as well as a tranche or more, one or more tranches of debt. This results in the physicians usually taking cash out of the deal, and that's part of their purchase price. And then the physicians, as we referred to, as we discussed earlier, will roll over anywhere. I usually see anywhere from 10 to 40%, and as we've seen purchase prices move higher and multiples move higher, we've tended to see the percentage that physicians are asked to hold back and keep in terms of rollover equity go higher. The idea being we want to make sure that these men and women have significant skin in the game, because they've taken an awful lot of cash off the table, and everybody's made a pretty big bet in this business on a go-forward basis. So those are the types of transaction structures, I guess, that I've seen.
Okay, thank you, Roger. Aaron, can you please add to this topic?
No, I think that was pretty comprehensive. In a growing economy and a hot one, I will say that recaps are more popular and easier to come by. Banks, so long as the spigot stays open at the banks, down to the extent that things cool and banks, have to rein in their horns a little bit, that'll make the recaps a little bit more challenging, and it'll impact valuations, overall, because low cost leverage, helps increase multiples. When that either when the cost of it goes up or when it disappears altogether, that's going to lower multiples. But and that'll impact recaps first more than anything else. But otherwise, I think it's all pretty much down the fairway. There aren't too many ways to skin the cat.
All right, well put, Aaron, well put. So this last question is going to go to all three of you, but we'll start with Joshua. What are the sectors that private equity groups are eyeing for the near term and for the future term, and why?
Well, so first on physician services, we're seeing a lot of interest in a variety of specialties, eye care being one of them. I think that's broader than just ophthalmology or optometry. Where we're seeing a real interest are platforms where there's an opportunity to roll up across the eye care service sector. So it'd be ophthalmology, optometry, as well as potentially even retail for eyeglasses. And so we've seen a number of successful platforms within the last 12 months interested in that space, particularly where there are surgery centers involved for cataracts or otherwise, as part of that platform. Within the last year, we've also seen an interest in gastroenterology. And since a deal was announced earlier this year, there's been a number of private equity funds that have expressed an interest in getting into or exploring the gastroenterology space, whether that be just on the physician service side or, again, physician services plus some of the ancillaries that are typical of a gastroenterology group, like endoscopy centers, for one. We've also, in the last year, seen a number of deals announced in the veterinary medicine space, and so we've seen, frankly, some multiples that are very significant in that space, and there's been quite an interest in that area as well. Dental continues to be a hot industry, and so we've seen a number of deals in that area as well. So that's a variety of physician services. In terms of why, that goes to what attracts PE funds to essentially any space. The opportunity to identify areas where there's scalability, the potential to add a greater degree of efficiency and growth. And so in each of those industries or service lines, you have certain markets that just lend themselves to allowing for a partner to come in, a financial partner to come in and partner with the physicians and bring exactly those types of aspects to the platform, to the group. And so for all of those reasons, it seems they are all interesting spaces to be in. We've seen some interest in urgent care and freestanding emergency rooms as well. I don't know if that's an area that remains as hot as it may have been 6 to 9 months ago, but certainly within certain markets, particularly in Texas, I think there is it remains a high degree of interest there. And then the last one I would throw in is pain management. For probably the same reasons as GI and ophthalmology or eye care, we're seeing a lot of interest in some fairly large pain management platforms that are getting a lot of attraction from PE funds.
Thank you very much, Joshua. Aaron, what are your thoughts?
Yeah, no, he hit on most of the hot sectors. I guess maybe the one I would add would be a lot of behavioral substance abuse recovery, in particular, addiction treatment. Is a very popular space, has been for the last few years, and is likely to continue to be. To sort of take the whys a little bit farther, the ACA has implemented a lot of changes across the marketplace, and although we don't know where it goes, there are a few things that I think most investment groups believe will continue in terms of a trend, and that is, one of them is a march towards value-based payments. And so, as you're sitting there as an owner, whether it be a physician practice or some other sort of medical platform, I think that's one question that every operator is asking themselves in the back of their mind is, how do I continue to not just survive, but thrive in a value-based payment environment? And one of the things that a lot of folks are concluding is that, as a smaller operator, it's harder to do. Because of the amount of, it's a risk share, and you have to be an very efficient operator, to have success in a value-based payment world, and that lends itself to scale. So that is driving certainly a lot of the activity from investments in terms of private equity, as they put groups together, look for ways to consolidate, gain scale, and then be able to eventually participate in value-based payments. We owned an urgent care platform that we built and exited successfully in the beginning of January. And I will tell you that one of the things that was floating in the back of our minds is, okay, today this is a fee-for-service business. As an independent, operator, how do we survive and continue to thrive in that environment? In many ways, it made a lot more sense for us to sell it to a large incumbent healthcare provider who could use that network that we had built differently. It was a good deal for us. It should be a great acquisition for them, in that future value-based payment world. So.
Thank you very much, Aaron. Now, Roger, what are your thoughts on the sectors that private equity groups are eyeballing right now?
Yeah, just a couple. One, two. I do echo Aaron. When you look at some of the large companies like Optum, DaVita, granted, not necessarily what you would consider traditional private equity plays, population health management, and the ability to aggregate large groups of physicians across a spectrum. Summit making a very large investment in DuPage Medical Group in sort of my neck of the woods, which is a 500-person physician group. So I think you'll continue to see more of that. There's some groups out there. There are some other private equity groups out there that make a lot of investments around the types of companies, medical management networks, network adequacy companies, those types of things. So anything around the ACA that gets you to this idea of value-based payments and the ability to manage the value-based payment is important. A couple of areas in physician services, we continue to see a lot of work around dermatology. Dermatology is a very hot area, and it is really the darling, and a lot of people have made a lot of money in dermatology. The why is because there's an awful lot of cash payments and non-Medicare payments that are made in dermatology. One area, though, that I think we are likely to see spark up here is, and it's an area that traditionally the physicians have been, wildly independent, is orthopedic surgery, neurosurgery, and orthopedic surgery. There are an awful lot of very large orthopedic groups. Maybe the whys is, one, there's still a lot of facility leverage in orthopedics. There's ambulatory surgery centers, there are physician-owned hospitals, there are procedures that you can still do. Imaging is still fairly hot. You can leverage into PT, even though some of the reimbursement in those areas is going down a bit. In addition, the why is, and I get this anecdotally by knowing some of the senior physicians in some of these very large groups, the way their cash out works is if you retire, you might take $2 or $3 million off the table when you retire from a group, even though you've made, a very large chunk of money while you're there. But your equity is only worth, pennies on the dollar compared to what it might be worth should you go through a recapitalization transaction with a private equity sponsor. So that's driving a lot of these physicians to say, listen, if I go outside, I can make a heck of a lot more money on the capital that I'm going to cash in than if I just simply, if our group stays private.
Okay, thank you very much, Roger. So we're going to move on to the question and answer segment of this webinar. We've got a few questions out there from the audience. The first one is going to be, have you seen any particular strategies developed by providers and private equity partners to mitigate against the risk of downward reimbursement pressure in payer contracts? We can let Joshua start this one off.
Strategies by PE funds and physician practices to mitigate against downward pressures from payers? Was that
Yes.
the question?
Yes.
Well, first and foremost, that's part of the reason to partner with a PE fund. If you believe that if you reach a certain level of size, you are now in a better position to negotiate with payers. Negotiation may not involve reimbursement lifts, although it could, but I'd say that's probably the exception. But certainly when you bring in a PE fund, we have seen success, particularly where those PE funds have been a catalyst for growth, to allow for a more sophisticated approach in the negotiations with payers, whether because you bring in a greater level of analytical tools that the PE fund may have access to or can help the physician group obtain, or because of management and leadership support from analysts which the PE fund hires. In both of those instances, though, coupled with growth, we have seen some very successful outcomes in terms of renegotiating terms with payers, particularly on the heels of a payer sending a termination letter to a group, and the ability, because they were not able to reach amicable terms in terms of a new rate, and ultimately when the PE fund came in, the ability to revisit those discussions and come out with a successful outcome certainly has been one of the benefits we've seen where groups have partnered with PE funds.
Okay, thank you very much, Joshua. Aaron, do you have anything to add to that before we move on to our final question?
Yeah, I think that one of the best strategies that we've seen, and that is often able to be executed with when you have private equity involved, is being able to bring more data. I'm sort of echoing a lot of what was said, but you come with a strategy that tends to do things like track outcomes. Think about it. If you're able to communicate how you've lowered readmits, or if you're able to confidently negotiate a case rate, versus a fee-for-service schedule. These are things that payers like. But to be able to go in and confidently be able to do that, you need systems and data. And the only way you're going to have that is if you've been willing to make the investment to do it and have the people to manage it. A private equity group should be a catalyst for making that happen if you don't have it already. And that is what's going to help you have a better, more productive conversation with payers.
Thank you, Aaron. Now we have time for one more question, and I'm going to hand this one over to Roger. How do you handle state law prohibitions on non-physician owners of physician practices, for example, corporate practice or medicine statutes?
Well, there's a pretty standard way to do that, and you have to remember, too, that all states are different, and all states there are some states that have, for example, like Florida, really has no corporate practice of medicine statute. It's got some statutes around, if you invest in a physician clinic, you've got to register, et cetera. But then there are some states that have absolute prohibitions on physicians or non-physicians investing in physician practices or owning physician practices. And what you really set up is, again, it's something that's fairly standard, and we call it a friendly PC or a friendly SC or a friendly corporation structure. And what you have is you have an entity that employs and or contracts with the physicians, and it tends to be owned by one physician, usually your friendly physician. The assets necessary to run that physician practice are usually then housed in a separate entity, which is your management company. Your management company will have a contract with that friendly physician around what he or she can do with the business of the physicians, and with the, not being able to lever it up, not being able to sell it. And usually you have the unilateral ability to move that physician out of that role. But what it does is that physician is your friendly doctor, right? And he or she takes care of that physician practice for you. You then have, through your management company, a management agreement that provides all of the assets you need to run the physician business, manages that physician business in exchange for a fee. Depending upon what state you're in, a certain amount of the profitability needs to remain in that physician practice. In many states, or in certain states, you can basically pull all of the profitability out of the physician practice through your management fee. And that's, of course, the profitability is after you've paid all the physicians. So that's kind of a standard way to do it. It should be noted, though, in some states have really started putting pressure and looking at these friendly PC structures. New York is a prime example. There was a case not long ago in which the company Aspen Dental, which is a dental practice management company, was fined and cited for kind of stepping over the line around the violation of the corporate practice of medicine statute in New York. And New York's a fairly strict statute, and I believe, and I can't right off the top of my head recall, there's also a recent case that came out of New York. So it used to be that we thought, well, we'd set up these friendly PC structures and nobody's ever going to bother us. There are some states that have shown a proclivity towards bothering you when it comes to that.
Thank you very much, Roger. So everyone, thank you for attending today's webinar. For more information on the discussed topic and related topics, please visit and subscribe to the Ambulatory M&A Advisor at www.ambulatoryadvisor.com. Also, I noticed that we had some technical difficulties going on earlier in the webinar and recently in the webinar. If you missed a portion of the presentation, be sure to check out the advisor's page for a posted recording later today. Joshua Kaye, Roger Strode, and Aaron Handler, thank you for participating in this event. I'm Richard Romero, and I will see you in the next webinar. Have a great day, everybody.
Thank you.
Thank you.